Hello, everyone. Thank you for joining us today for this webinar. I'm Sheldon McFarland, Vice President of Portfolio Strategy and Research at Loring Ward, and I'll be your host for today's webinar. This webinar is provided by LWI Financial, Inc., Loring Ward, an investment advisor registered with the Securities and Exchange Commission. Securities offered through Loring Ward Securities, Inc., member FINRA SIPC. Our presentation today will last approximately 30 minutes, followed by a 10-minute question and answer segment. To ask a question, open your GoToWebinar control panel by clicking on the orange arrow icon. Type your question into the question box and hit send. Please feel free to ask questions at any time during the presentation. Your questions will not be viewable by other attendees and will be addressed during the Q&A segment at the end of the webinar. I ask that you keep all questions general in nature and refrain from submitting questions pertaining to your specific investment situation or portfolio, as we cannot address them on this webinar. All participants will be in listen-only mode for the duration of the webinar. You may have noticed we have a new title on screen. We are expanding the scope of our traditional quarter in review webinar to give you more. It will include perspective on current markets in addition to a review from last quarter. So welcome to Market on Your Mind. With me today is my good friend and colleague, Matt Carvalho, Director of Investment Research at Loring Ward. Matt, welcome.
Thank you, Sheldon.
For this installment of Market on Your Mind, we gathered your top investment questions. We'll go through them, as many of you may have similar questions. After that, we'll take a look back at recent markets. So given that we've seen a lot of turbulence in the markets lately, a lot of clients are asking, why has performance been so painful?
Well, thanks for the introduction there, Sheldon. And I think, whenever we want to determine if recent performance has really been good or bad, we always need something to compare it to. And oftentimes, in most investors' minds, that's something like the historical average return that we see on the different indexes. But what is really an average return? Well, we're going to start off with this chart here that shows the annual S&P 500 returns from the most recent year all the way back to 1926. And as a reminder, we use the S&P 500 quite a bit in this deck because it's really a collection of the largest 500 companies headquartered here in the U.S., and it's been in existence for quite a long time and is fairly familiar to most investors. So I think it's a good kind of benchmark to start with. But when you look at these average returns, annual returns, you really see that there is no average. The year-to-year returns are all over the map, ranging from positive 40% to minus 40% in any given year. And yet, somehow, we always see that long-term average number, somewhere in the neighborhood of maybe 8 to 10%. But how does an investor actually capture that? Well, we need to remember that returns are in large part a function of the amount of time that you're invested. So if we look at this second chart here, what we've actually looked at is the rolling cumulative average looking backwards in time. So this is a little bit different than we've typically done it in the past. But I wanted to highlight the ability to look back and say, well, in 2015, we know returns weren't that great. We can see returns here of just over 1% this most recent calendar year. But if we go back a couple years, an investor that started January 1st, 2013, they got a 30% increase that year, they got about a 10% the next year, and then the 1% from last year. Well, over that 3-year period, they had an annualized return of about 15%, which is much better than historical average. But you keep going back in time, you add in some periods like 2008 with a pretty dramatic down market, and some of the negative returns in the early 2000s, and you can actually see the investor that started January 1 of the year 2000, over the next 16 years, he's only gotten a return of about 5%, so below the historical average. But then we do see that the longer in time that you go, the more likely you are to hone in on that long-term average. So periods like anywhere from 1990 all the way back to 1930, investors from those periods up until today would have experienced that long-term return that you'd probably expected. Now, another way to look at long-term returns is something like historical distributions. So on this one, what we've done is actually just taken the annual returns and put them into buckets. with basically every 10% return being represented here, going from a minus 40 to 50% return like we saw in 1931, all the way through the majority of the returns we see here, all the way to the other side where we see a positive 50 to 60% return during several other years. So we're just grouping individual annual returns by their different frequencies. Well, this really kind of reminds me of the Plinko game on The Price is Right, where if you were to just drop these chips year by year, you'd actually see them bounce around fairly randomly. But over time, the more of them that you drop, the more returns that you're going to get towards this middle area here. And in fact, about 80% of calendar years have landed somewhere in this range of somewhere between a minus 10% return and a positive 40% return. And in fact, that's actually what we've seen with all 7 previous years falling into that time period, most recently here, 2015. Now, the takeaway here is that while 2015's return was indeed below the historical average, it was very much in line with what we would call a normal outcome. Now, if you had sold after something like a dramatically negative return that we saw way over here in 2008, you would have missed out on those 7 years of gains.
So looking at this, it feels to me like if we're making changes in our portfolio given recent performance, especially 2015, 1% return, and we make a change, it's like driving looking in the rearview mirror because we're looking at what's happened in the past, not necessarily what is to come in the future.
Right, I think that's a great point that is actually going to lead right into a quick little quiz that we wanted to bring up. So we wanted to launch a poll right now to help make these webinars a little bit more interactive. And so you're going to see a poll come up on your screen, and here we have it. And the question is just, what do you believe the return on the S&P 500 in 2016 will be? And we have a couple of different answers on there. And just as a reminder, so far as of the close of the markets yesterday, the S&P 500 is down about 8% for the year. And we certainly know that a lot of investors are worried about what the market has done early in the year, just this January. So the variety of responses we have here, something like a 10+% return, meaning that the markets would rally pretty significantly from where they are today. We could see something like we saw last year with a positive single-digit return, anywhere between 0 and 10%. You could predict that the market's going to stay right about where it is with the single-digit loss for the year, that perhaps it might weaken a little bit, the minus 10 to minus 20% range, or it could go down from here and more significantly so into that last category there of a minus 20% or worse return. So we're getting a lot of votes in right now. We'll leave that open just a second or two longer. And again, this is just an interesting way to kind of look at the wisdom of crowds and see what people are thinking right now. All right, so it looks like we've gotten actually just about everybody voted here. So we'll show the results. And here we show that 68% of the vote was actually that the S&P was going to end with a positive year, somewhere in the 0 to 10% range. So overall, a pretty optimistic crowd. I like that quite a bit. I think when it comes to the returns that we've seen in January this year, I want to try and put those in perspective a little bit. So we actually went back and looked at the intra-year declines on the S&P 500. And what you're seeing here is these green bars are the historical return for the calendar year, so from January 1st to December 31st. And the orange bars here are the drawdown during that current year. So for example, when the market hit a high at one point during the year and then a subsequent low, what the difference between those two returns were. And over time, we see this over the last 30 years that we're showing here, but in fact, if we look back over the entire history of the S&P 500, we see the long-term average tends to be right around a 10% annual intra-year drawdown. And basically what that means is that the drawdown we've seen in January is actually nothing but normal. And I think the important part to note here is that bad drawdowns or bad losses at some point during the year really do not mean bad annual returns. So if we look back a couple of years here, say for example 2010, we actually saw a loss during the year of 13%. But at the end of the year, investors in there for the whole year actually saw gains of 15% on their investments. If we look back further in time, think back to 1987. We all know about the stock market crash that happened that October, losing 22% in one day. Well, at one point, investors that year were down about 30%. And yet an investor that started in January and ended at the end of December actually saw the value of their investments rise by 5%. So I think the other takeaway here is just that recent years have actually been less volatile than the long-term average. If we look at these last couple in 2014, 2013, and 2012, those have been less volatile than average. So to me, the key point of this slide is that we don't want to let that short-term volatility that we're seeing right now scare us, but in fact, we should remember that it's actually quite normal.
So if I'm understanding you correctly, Matt, we should expect declines within the year every year, but over the long term, we should expect to earn close to that historical average. But what is the long term? What would you say?
Right. Well, that's always a good question. We think investors need to have a long-term perspective because nobody knows what's going to happen on the markets in any given year. But I think a typical investment time horizon for a lot of people is actually closer to 30 to 40 years. We often show numbers, over 10-year periods, 15-year periods, because, we all kind of want to know what's happened recently on things. But I think when you're trying to put together a long-term plan, that the more time horizon that you have, the better, the kind of narrower expectations you can have on what you might be able to expect. When you look over shorter periods, as we can see in all these charts, you just don't know what's going to happen year to year on the markets.
So when you say that we're long-term investors, that means 20, 30 years or more in order to earn some of these returns that we're talking about or get close to that historical average, right? Speaking of long-term, the next question here, we've seen small in value, those returns or that we try to capture within our portfolios or those tilts that we take, we've seen that over the last decade, so those haven't paid off. They've underperformed just the market in general. Why not just buy the S&P 500 or the market?
Sure. Well, that is a good question, and it came up recently as the S&P 500, basically U.S. large cap securities have done pretty well. If we look at these numbers in 2015, we can see that basically large cap securities, so these boxes up here, did better than their small cap counterparts. And we can look at value or neutral or growth, kind of referring to the book to market on different securities. But today we really want to just talk about in general the idea of large cap securities versus small cap. And so just as a reminder, a large cap security would be something like Google, an extremely large company. And somewhere on the smaller end might be something like Buffalo Wild Wings. So these are both, fairly familiar names. But when you look at things like revenues, Google had revenues over the last year of $66 billion. Buffalo Wild Wings had about $1.5 billion in revenue. And when you look at the market capitalization, basically the value that all the investors in the market as a whole are saying what a company is worth, well, somewhere like Google is about $500 billion in value, whereas Buffalo Wild Wings in this example was about $3 billion in value. So it's about 150 times larger. And, in some cases, certainly in 2015, these larger cap securities did better than their small cap counterparts. But we wanted to kind of set a reminder why you may want to have more than just those large cap securities in your portfolio. So if we actually take kind of a case study here, and with the reminder that most companies don't start off large. So we wanted to look up the example of Netflix, which was actually one of the best performing stocks in 2015. And I think now it's a company that we're all intimately familiar with. But if we look back in time, well, they had their IPO back in May 2002. And if you can think back to then, chances are in those days, we were still going to Blockbuster to rent videos, right? Nobody was streaming content from, their own home. But you fast forward, they start adding content. More and more people have faster and faster internet connections. They start expanding around the world to, over 100 countries now. And at some point in December 2010, actually, they get added to the S&P 500, meaning that they are now a large cap company here in the U.S. They were added to an index like that at that particular date, and they continue to have growth from there. As I mentioned, they were one of the best performing stocks last year. Really, the last couple of years, they've had phenomenal growth, and they've made their investors about 345% over those years, which is great. But if you look at this chart and you look back, this is an exponential growth here. And if we look back to the difference from when they were originally became a public company, initial public offering, to the date that they were basically deemed a large cap security, well, they actually had far greater growth during this first part of their history, 2,000+%. So investors who had only held large cap securities over all these years would have missed out on this original growth. They would have captured the later point, but they would have missed out on the far greater returns that happened earlier on in the company's history. But if you were an investor that had a globally diversified portfolio with large cap securities, with small cap securities, then chances are you owned companies like Netflix during their whole existence, as opposed to only after they had became a large cap security. Now, certainly we know over the last years, we mentioned, large cap companies did better. But when we look over longer time periods, it's not going to hold every year, but over the long-term history of the markets, we've generally seen small cap securities perform better than their large cap counterparts, similar to what we just went through with Netflix, that it had a little bit faster growth as it was a smaller company, and that growth was still good, but it did slow a little bit as a large cap company. Now, again, that's not going to happen every year. As we've seen this year or several years recently, large cap securities like those in the S&P 500 might do better. But at the end of the day, if you're looking over the long term, and as Sheldon mentioned, we're thinking 20, 30, 40 years here, the chances are, it's going to be good to have these other asset allocations within your portfolio.
But Matt, if these have been underperforming, say small and value recently, over the last decade, why wouldn't I just overweight these securities in my portfolio now?
Sure. Well, no, it's a good question. And the answer is really, we just don't know what years they're going to outperform. So if we go on to what we would call the Skittles chart here, basically each box represents a different asset class over time, and these are annual returns just stacked accordingly to which asset class did the best that year and which one did the worst. So we can see U.S. small cap was towards the bottom last year. It returned minus 4.4%. But in the year before, it was a little bit higher up, did pretty well. And in 2013, it was actually one of the best performers. But these are going to vary pretty widely. You can look all the way back in time to, say, 2002, when it was also one of the worst performers. So we don't know which year it's going to pay off, but if we can try and hold those exposures over time, we're going to ensure that a diversified portfolio is going to capture those gains when they do occur. And that's what we're showing here with this white box representing a 65% stock, 35% fixed income mix, just to give you an idea of if you had stock of a lot of different types, not just U.S. large cap stocks like we see in this yellow box, but all different types of holdings, that over time, you're generally able to get a return, somewhere close to the middle of all those different asset classes, and you're able to do so with the lower volatility. So you're able to avoid some of those outliers, because those are the ones that can really derail your portfolio if you get some of these years where you get very significant losses.
Great. Our next question. Given what we've seen in China, this, what seems to be a meltdown of their market, and the pressure that that's putting on the rest of the world and Europe, and slowdowns, and it seems like international investments just aren't a good investment right now. Why bother with international within our portfolios?
Right. Well, it seems like this is a question that certainly been coming up the last couple of years, because international returns have lagged their U.S. counterparts. But I think we should first kind of step back as investors and really ask, what are we trying to do when it comes to global diversification? Well, for me, it's the idea that I want to own a share in the profits of all the great companies around the world. And so in the example we're bringing up on the screen now, this is a look at just the auto industry and a variety of names of cars that people out there are driving today. And if we look at that and we were to say, okay, there's all these great companies around the world in Germany, Japan, South Korea, as well as the U.S., well, if we only limited our investments to those from the U.S., we'd be left with a much smaller pool. In fact, probably a lot of us are driving cars that aren't even listed there anymore. So I think the fact that if we're out there as consumers buying products in something we think is a good value, that as investors we should also want to own those companies. But we certainly understand that recently international returns have been lower, and that's been in large part due to the continued appreciation of the U.S. dollar. And that's really been the last couple of years now. And so we showed a chart like this about a year ago, and we're actually going to see very similar results in 2015. So when you look around the world at international developed value stocks, we had an example a couple quarters ago about Mercedes-Benz, how it was actually up in terms of its value on the Frankfurt Exchange. But when you considered that a euro was worth less than compared to a dollar than it was at the start of the year, it actually decreased in price. Well, we saw a similar case this year where international developed value stocks were basically flat, down just a fraction of a percent here at minus 0.7%. But the dollar impact knocked off an additional 7%, showing that, much larger negative return than you would otherwise expect. International markets were down to a greater degree, but again, really concentrated losses when looked at in USD. So when we see it on our statements as a US investor in US dollars, much greater difference than the actual change was on those local currencies, so those euros or yen or pounds around the world. And so, we've mentioned also in the past how year to year it's going to help some years and it's going to hurt some years. We just don't know which direction the US dollar is going to go year to year. So we thought it might be good to actually see that year-by-year impact in a better illustration. So what we're showing here is first highlighting all those years that had down years in terms of the impact to international investments. And this is basically just the years when the US dollar appreciated, as we saw last year and the 2 years before that. So we know it's certainly happened over time during different periods, but you can tell, similar to the other return charts, it is, in fact, very random. And then if we then focus on the opposite, which basically was just the same amount of years when the US dollar depreciated, well, those were times when your international holdings were actually helped out by being denominated in foreign currencies. If we look back to the 80s here, there was actually a 3-year period where you were gaining more than 25% per year on top of your returns just simply because the dollar was depreciating at that time. And we know this can, get lumped into some kind of waves here. As we've seen in this decade, the US dollar has appreciated against those other currencies, and so that's knocked off 18% from international returns over the last 6 years, and that's pretty meaningful. That's really driving a big part of the difference about why it looks that international has underperformed their U.S. counterparts. But if we look back to the decade before that, in the 2000s, we actually see that it added 29%. And keep in mind, this was a time when the S&P 500 was basically flat for the entire decade, and international returns were positive. They were helping out globally diversified portfolios, and then they were getting this additional boost of the currency depreciating, which was also driving those returns even higher.
Our next question here. It seems, as a client, when I look at my statement, a lot of the asset classes that we're investing in are falling behind or underperforming just the S&P 500. Am I falling behind with a few bad years, and am I still on track to this thing called the long term?
Right. Well, that is certainly a concern of all of ours, right? We want to make sure that we're progressing towards those goals. So, to kind of answer that question, I wanted to first start off with bringing the Skittles chart back up. And, we've looked at this in a lot of different ways, and I think it can really tell a lot of great stories. But I think, when we talked about the long time horizon earlier, this is just the last 15 years. And we really believe that most people, if you're close to retirement, even if you're already in retirement, you probably really have a legitimate case to make that 30 or 40 years might still be your time horizon. And we would put that all in one slide, but it would just be too unreadable. So we typically limit it to somewhere around 15 years like this. But I wanted to take this and use the idea that each one of these asset class annual returns really can be broken up and thought of individually. But then we know that each annual return is actually made up of 12 different monthly returns for each one of those asset classes. And those are all going to be slightly different, moving in one direction or the other. But yet even each one of those monthly returns can be broken down even further into daily returns. And I think when we view it that way, it really becomes apparent just how insignificant any single day during these years are. The return on any asset class on any single day is really going to be, a very small impact to your long-term portfolio returns. On this chart, I thought it was interesting to look back over the last couple of years, and I highlighted one here that was actually August 8th of 2011. I wanted to ask if anybody on the line remembered what happened that day. Well, I didn't remember what happened that day until I looked back, but that was actually one of the worst performing days in percentage terms on the S&P 500. It was down 6.6% that day. And this wasn't the flash crash. This wasn't any part of the financial crisis the couple years before that. This was simply a day when the market said, they didn't like some of the news that came out, and there's some worries about international growth, and all these different things just kind of came together to say, this is going to be a really ugly day on the markets. But we have to remember that this happens. If we had panicked and sold out during this day right here, August 8th, 2011, we literally would have missed out on a 100% gain since that time on the S&P 500. Now, I think this illustration really just shows that any single day, week, or even month has very little impact on your goals. So instead, I think that we should visualize these days as just little pixels that really make up the vision of our long-term financial plan. Whether that's something like retiring on the beach, I know that's one of my goals, to be able to sit back and read a lot of books out there. Perhaps it's something like funding grandchildren's, college tuition, or making big contributions to charities that you care about. Whatever it is, if you're making sure that you're doing everything right to accomplish those goals with your financial plan, that's going to be a lot more productive than focusing on any one period in the market.
Great, Matt. Thank you. Good discussion. So given everything that we're seeing, any concerns that you have or that you think we should be as investors should be concerned about right now?
Sure. Well, so we've had a couple slides here of, more of a specific 2015 look back. And what we wanted to do there was just kind of dive into the investor sentiment again. So I thought this was a pretty good indication. This was from a Bloomberg article that was actually why October is the worst month for investors. And they have some pretty scary things on here, right? Like the market's going down so bad you're having to sell everything, that you're going to have to list Granny's Pearls on Craigslist, or that you might only have 112 years left of work until retirement.
It's no worry that, or no wonder October is such a bad month. When we look at this here, we've got, in addition to Columbus Day, we've got anniversary of Black Monday. We've got the anniversary of the 1929 market crash. So a lot of omens and bad anniversaries in October.
All right, so we want to move along here and say, well, going into the third quarter, there was another report from Yahoo Finance. Basically said, good news, no one expects much from stocks. And that was really the sentiment at the time, right? Not so great expectations. Or, I think this is a great line, the path to happiness begins with low expectations. That's probably very true. But in fact, when we actually looked at returns for the year, we saw some really great returns. In fact, something like U.S. real estate investment trusts, so basically, buildings and malls, things like that, were up 7.5%. U.S. large cap, so basically that S&P 500 index that we've been talking about, was up 7%. International small had a great quarter. And all in all, portfolios were up quite dramatically. And so when we look back to something like that article that came out in Bloomberg magazine, well, that actually came out on October 8th. And so it was really well before anything had really happened in the month, I'm sure, when they were creating it, but it was simply representing the sentiment that we were coming off of, this August and September that were really rocky months in the market. And so with that, I wanted to bring up one more poll here, and just want to see, looking back, coming off those fresh 2015 numbers, which asset class do you believe had the highest return in 2015? So we had a couple different options here, something like high dividend paying stocks. So this was certainly an area that many investors went to searching for yield in a very low interest rate environment. We have short-term bonds here, which could have been pressured from the Fed rising rates for the first time. There's gold that was, kind of always presented as a safe haven for, volatile markets, or something like oil, which, had just came off some significant losses in 2014. Was that going to bounce back and see some gains during that period? So we'll give you just a second longer here to vote on these, and then we'll take a look at the results and the actual returns on there. All right, so we'll show those results now, and we can see, looks like just by a hair, high dividend paying stocks was the highest selection. Short-term bonds basically neck and neck with that, and then some lower results for gold and oil. So I'd say, this was very interesting to look at. When we actually pulled these different returns, we can see that high dividend paying stocks actually had a pretty negative return, down 15% for the year. This was really, meant to be kind of a safe haven, or somewhere that people were going to try and get that couple percent more in yield for the year, but those are actually one of the worst performing areas of the stock market. Short-term bonds were the winner in this case, basically eking out a 1% gain for the year, whereas gold was down 11%, and then oil continued its fall, much as we've seen in January here, losing 45% during the calendar year of 2015. So there's another article that came out basically entitling 2015 as the year that nothing worked. Stocks, bonds, and cash go nowhere. But certainly we don't need to watch a video of a guy yawning to tell us that markets weren't exactly exciting in the upward sense, at least in 2015. But if we do take a look at the returns, we can see there is a pretty big variety between something like international small cap, that was actually the best performing asset class here on this list, of gaining 5.5%. U.S. REITs, and as we mentioned, something like the S&P 500 was up marginally, but there was a couple that were down, and as we discussed, a lot of these had in big part ways related to the impact of the U.S. dollar, taking something like international large value from a minus 0.7% return to a minus 7.7% return. But I think it is interesting to then also plot some of those other areas that we talk about and see, or excuse me, that we just brought up in the poll, and see where those look like in comparison. So I wanted to end with one last idea, because I think it's easy, whenever markets are relatively flat or even down, 5-10% or however much, to always think, there must be something else. There must be some, silver bullet out there, or I hear my neighbor or my coworker is, making all these returns in whatever they're doing. And 2015 was certainly full of distractions in the headlines, right? With the Fed raising rates, oil plummeting, there was troubles in Greece, and certainly ongoing issues with the China stock market, and pretty flat markets overall for the year. So this really should have been a great year for stock pickers. If they were able to find the diamonds in the rough during these tough markets, then this really would have been the year for them to shine. Well, we looked high and low for them, but we really couldn't find them. In fact, we found a lot of results like this. So we looked around at a lot of the predictions for 2015, and some of those that were actually going out there and naming their hand-picked selections. So something like Kiplinger's, which is a newsletter that goes out to stock investors, they had their top 25 picks for 2015. Well, on average, those 25 were down 8%, so much worse than the overall market. And out of those 25, 8 of them actually lost greater than 20%, and 2 of them actually lost more than 70%. We saw another case like that with Fortune, a pretty well-known magazine out there. They had 63 picks, kind of running the gamut of different areas. They had gold on their cover there, which we saw didn't do too well itself. On average, they were down a similar amount, down 7%. And one of the highest touted picks in their magazine, and actually in many of the others that we looked at, was Freeport-McMoRan, which actually lost 70% during the last year. So I think the takeaway here for investors is just to remember that we don't need to beat the market each year to reach those long-term goals. But we do need to avoid some disasters like these. And we can try and avoid those wild swings by sticking with a diversified portfolio. And in some years like 2015, simply treading water as a result was probably something most other investors would be envious of.
And another lesson we can learn from this is diversification. 63 picks seems like a pretty good number, but if you invested in those 63, you may have thought you were diversified. You were down 7% versus the S&P. So once again, diversification, a lot more than just 63 names in a portfolio. Matt, thank you again for a very informative session. I'd like to open it up now for our Q&A segment. Again, to ask a question, open your GoToWebinar control panel by clicking on the orange arrow icon. Type your question into the question box and hit send. Your questions will not be viewable by other attendees. So we've got several questions in. First one here, I'm worried about a political outcome I don't agree with. Politics and especially presidential elections is on everyone's minds right now, and what's the impact of that election outcome on stock markets and my investing future. I actually did some research on this. We've got several pieces available from Loring Ward on the topic, but one of the recent ones, an article that I put together, who is the stock market voting for? What I did is went back and looked since 1926 at the times when Democrats and Republicans controlled office, and it was roughly split over that time. 46 years that Democrats controlled office, 43 that Republicans controlled office. The Democrats had a slight edge. The average return during a Democratic president was 15.3% versus 8.6% for a Republican. But before we jump to any conclusions, we've got to step back a minute and think, given that we've got that limited data set, we really can't statistically or with any type of statistical certainty distinguish those two averages. The other thing is that chance plays a large part in the results. Something like the Great Recession that we had, or the World Trade Center. Think of any of the catastrophes that have happened that have impacted the markets. A lot of times those are just chance, and it may happen during a time that a Democrat is controlling office or a Republican. The other thing is that the calendar returns don't necessarily tell the entire story. A lot of times the market is forecasting the outcome of these elections beforehand, and those things are getting priced into the market. And the last thing I would say is, with the tripartite system of government, how much power does the president actually have in influencing the economy and some of those other things? It might be less power than we believe, and they may have less impact than we believe. So before you get worried about or think about making changes to your investments because of the elections, think about those things. There may be a lot less correlation between the president outcome of the election and market returns than you think. Next question here. Aren't we headed for a recession?
Sure. Well, certainly, is a question that we hear getting asked more these days with, the market turning down, fairly significantly here in January. But we always have to remember that the market is not the economy and the economy is not the market. Now, there is some relationship between the two there, that you can't have one going up forever without the other one being positive. But at the same time, we have to remember the market is incorporating all this information, as quickly as it gets it, looking out at, the long term, right? Just as we say we need to be long-term investors, if you're an analyst, trying to price the value of Google that we looked at, well, you have to try and guess what their profits are going to be over the next 50 plus years, as opposed to just what it might be tomorrow. And so I think, if we just look at the actual data out there in terms of the economy and if it's pointing to a recession or not, I think it's pretty clear that most of the data is not. If we look at GDP growth, we're still growing, certainly not at rates that most people would like in the higher percentages, but we're more or less in this 2 to 3% type of growth that we've seen really since 2009. The unemployment rate has came down quite dramatically over the last couple of years, and job creation is actually really robust. If we look at the numbers that have come in this fall and into winter, they've actually been better than we saw through most of the previous year. I know around here home prices are still going crazy, and the national numbers continue to rise as well. And inflation is very low, so the price that we're paying at the pump is much less than it was a year or two ago, and that really translates into direct savings. The impact to every family is, I think I've seen it estimated anywhere between maybe $500 to $1,000 a year, which is a pretty big, nice buffer, that people can use to, either consume more or to pay down debts, things like that. But that is a nice increase to the bottom line for a lot of people. So, I don't think there's any economists out there that can predict predictions or that the stock markets do either. But, I think as a long-term investor, if we can ride out the ups and downs whenever they come along, that we're going to be a lot better served than, trying to guess when that might happen.
Another question here is, it seems we're experiencing several unprecedented changes in our global and domestic markets. Is Loring Ward still confident that value, small and international exposures are appropriate?
Well, I would say so. I think, our stance has always been a very strategic, long-term oriented view that we understand, things like small cap securities that we looked at just earlier in the deck, they're not going to outperform every year. International markets aren't going to outperform every year. But, over time, a lot of these returns tend to, converge to pretty similar numbers. And so we think if you're a diversified global investor, that if you can hold that basket of securities over the long run, you can rebalance in the meantime. So, if you're adding money to an account or rebalancing over time, then you're going to be buying those securities that are, at a lower relative price compared to others, basically buying low and selling high, that those things, actually help you out. It's better for a portfolio if not every asset class moves in the same direction every year. It's better off if you have some years when the U.S. outperforms and some years when international outperforms. So we think as long as you have a broadly diversified portfolio that meets your situation, then that's going to be a lot better off than trying to predict when we might have a recession here or what exactly the GDP growth will be in China or any other country in particular.
Yeah, and I would add to that as well that a lot of times what we feel is unprecedented in the markets really isn't. If we look back in history, the world has been struggling with the same issues in the nation. We've seen times where inflation has been a fear, where debt has been a fear, where unemployment has been a fear, where global slowdowns have been a fear. So a lot of these things that we're seeing really, I would argue, probably not unprecedented. We've seen a lot of these things before if you look back in history. So a lot of times, it's not something new that the market hasn't seen. Another question here, is there any discussion in investment committee regarding adding factors such as momentum or profitability to the global portfolios in light of underperforming benchmarks over the last 10 years?
Well, I'd say, as investors, you always want to make sure that you're capturing those areas of the market that you think are going to provide those long-term returns. So certainly, part of what we do here at Loring Ward is trying to evaluate those and make sure that we're, helping with the asset allocations that will help you reach your goals. So we're always looking at those things in terms of, is there any additional ways that you can create a more diversified portfolio that can try and reduce that volatility a little bit further. So it's always something that we're, up to date on all the research out there. But, you really have to have a pretty high hurdle to new developments out there. We see a lot of things that get researched and might look like they could potentially have great returns, but then when people try to actually implement them, that they really have a lot of trouble bringing those returns to actually be delivered that they thought they would when they just looked backward in time. Or the idea that once it was discovered, perhaps it's potentially no longer there or gets arbitraged away in the market. So I think we're always looking to make sure that portfolios are set up in the best way possible. But I think if you're trying to adapt to every new strategy out there, you're probably going to incur a lot more costs and do more harm to a portfolio than you would otherwise.
And also, I'd add to that some of the trading screens that we have on the portfolios, we're capturing those factors as well. So the profitability screens as well as some momentum. So not something that we're not capturing within the portfolios. Let's see, we've got time for one more question here. Won't these recent flat returns hurt my financial plan?
Sure, that's I think one of the pressing questions these days, right? When we've seen 2 years in a row now where global market returns have been fairly flat, and that's really a concern. Everybody wants to make sure that they're making progress towards their goals. So I think I'd say that first off, financial plans take that into consideration, right? If you look back, what happened in the early 2000s, in 2008. All those other years, things like those are incorporated into financial plans, knowing that markets aren't going to have great returns every single year. There's going to be periods when you're below average, and periods like 2013 when everything is above average. And at the end of the day, I think we have to acknowledge that we can't predict what market returns are going to be, especially year to year. So on the most conservative end, if you want to ensure that you have the greatest chances for success, with your portfolio meeting your goals, there are things that are in your control. So the market returns are something that we just can't control, but we can control, how much exposure we have to stocks compared to bonds to try and, get a better gauge of what the risk in the portfolio may be. And then we can also control other things like the amount that we're saving. So if we, want to save more into a portfolio, we can have a better likelihood of meeting those goals. Or if we're already in retirement, if there's some way to reduce the spending, to reduce the withdrawal amount on the portfolio by some small degree, those changes are going to go a long ways to, really determining if a portfolio is going to deliver the results that you're looking for. Those are things that can really build an extra measure of safety to a portfolio.
Great. Thank you, Matt, for your time today. I just want to point out that we have a replay today at 5 p.m. for any of you. That's 5 p.m. Pacific. For anyone that joined late and wanted to catch up with us again, we will be on later today, as well as slides and a recording we will make available on our website, so you can have that if you want to listen to at a later date and go through the slides. So just to wrap up here, once again, we can't predict markets, but we can prepare for them. And our experience tells us that successful investing is goal-focused and plan-driven. So until next time, goodbye.